get involved with a little bit more of the technical side of things. There has to be more numbers tied with philosophical process and roadmap with that. And I don't want to take too much of our time to break down certain aspects. So Jason did just hit record, so please go back and watch this one. And then from there, if you have questions or need follow-up, by all means, let's hop on. I can promise you, I believe all angles of this, as far as the numbers, have been thought through. But happy to discuss it with you. So let's dive in. Let me go and share my screen. And okay, so here's kind of the first the rundown, just recapping it. WBC, all about how do we make the most efficient decisions financially with all of our long-term savings. Okay, so not short-term, but in the long term, recognizing that number one goal is to generate income, or the number one purpose is generate income when we get to retirement. So beginning with the end in mind, recognizing that, hey, we need to focus on how is income going to function so that it provides a roadmap for how we can position our savings between now and when we get there. Not all the time. In fact, most of the time we can't undo what our clients have done to this point, right? And another side note, I think, Bill, it was you, it may have been Jeremy, that mentioned, also the client communication aspect of it. Let's be very, very clear, because I've stepped on my own toes so many times in my career. Let's never not be encouraging to our clients, or furthermore, like what they've done to this point. Let's be careful with our words, not to offend them. They may have been able to make better decisions, and perhaps you're going to share that, shed that light to them. But at the end of the day, if people are saving money, man, they are bettering themselves, and they're on the right track. So can't undo a lot of what they've done, but from this point moving forward, how do we best position them? Then rolling into IBC was really around this idea of control and recapturing lost opportunity cost. From a financial perspective, if I'm committing to doing X with my money and I exchange cash for that product, that experience, whatever it might be, I may not be paying interest on those dollars because I paid cash for it, but I am giving up the ability to earn interest. And so this idea that we all only get one compound curve in our lifetime, and the driver of that is time. Okay, so how do we put as much of our financial resources onto our compound curve as possible? And perhaps if we just change the starting point of how we acquire expenditures of life, or how we enter investment opportunities that come our way, could that make a larger impact for us? And to this point, we've seen that, hey, just looking at our real estate example of last week, yeah, that's possible. Okay, so the idea here, infinite banking, means there are endless examples, there are infinite possibilities that we could go over with this. I believe in conjunction with last week, the case we're going to look at today brings in a different element. Rather than an investment opportunity, it's more of a huge ticket item expenditure for this family. And again, I think this will just tie in perfectly. So with that, let's dive into it. And I am going to pull up here. Okay, you should be able to see the screen. Okay, we're first going to look at this case from a WBC perspective, and these were clients of mine. This was 2017, 17, I believe, and really involved case, and it's great. And what I want to highlight here, again, we have the recording. I am going to show you the WBC calculator just to give you a rundown of their assets and this type of positioning. But this is not going to be about how did I input all this, or how did the build work. Different session for a different day. So we don't have to spend too much time with that. Okay, so as you can see here, Jay and Wendy in their early 50s, Jay's 51, Wendy 52. Going to retire in 14 years. Wendy worked for, she was a museum director, and Jay was a pathologist. Combined household income about $275,000. What you can see here, the first set here, their assumed current tax rate 30%. the growth rate that I was going to use between this point moving forward. So over the next 14 years, their retirement accounts, what was the net rate of return they were going to grow at? This needs to be a discussion with your clients. Some of you on this call are heavy in the wealth management space, and you're likely already having these conversations. Others of you, perhaps not so much. And so having that dialogue with the client is extremely important, just to get their agreement of how we're projecting this moving forward. Okay, so in this instance, 6% net rate of return. And then it comes down to, hey, once I get to retirement, what is that safe withdrawal rate? All right, and we're using 3.5%, which, if you recall from session 1 and 2, what my language with that was, hey, look, this started at 4%. Much of the industry is settling on somewhere between 3 and 4. We looked at Morningstar that said 2.8, and so on and so forth. So in that dialogue is when I'm getting agreement with them that, hey, how about we split the difference of 3 and 4 and call it 3.5? We do not move forward, remember, until they totally understand those points. But in any event, here's where we are at. Okay, so those are the assumptions. Now this right here, let's look at the list of their assets. Okay, so Jay in his 401k, just over 400,000, has a Roth account with 70,000, a brokerage account 150. Wendy has 125 in her 401k, 115 in her Roth, and 140 in her non-qual account. So do these people have financial resources? Yes. Do they make a great combined household income? Yes. One of the things that was so cool when I first met Jay and Wendy, they were referrals of mine. They lived in Ohio, and their entire life had always been buy term and invest the difference, folks. All right. Now I believe that Dave Ramsey does some fine things for folks. The problem, in my opinion, that Dave does is he uses a wide brush and applies absolute statements to everyone's situation, which is just not always the case, right? And for many of us, we know that Dave has very ill thoughts towards whole life insurance as a tool. That part I flat out disagree with, but Jay and Wendy were 100% all buy term and invest the difference. And as we look at this, I would say financially speaking, they've done a pretty good job. One of the problems with buy term and invest the difference, side note, folks, is human behavior. All right. And when people get out of debt, they don't then continue to save that money or invest that money. They then consume that money. Right. It's one of the biggest issues. Jay and Wendy did not have that problem. In fact, when you look at their cash flow here, okay, on the personal contributions, same account balances, here's everything that they were contributing. All right. If all of that, you can see here, if all of that was pre-tax money, they're saving about 50 grand a year. If all of it was after tax, given their tax rate, about 35,000. So depending upon how you would want to look at it, they're saving over 15% of their income. They're good savers. They've been doing it for a while. They're very disciplined people. Okay. Now, where this started, and I'm not going to get into much of the buildup because I kind of want to fast forward directly to where we were about to end this conversation. So as you can see here, before I show this, will someone come off of mute? And when I went over the covered asset strategy and I talked about a ratio, and I said, look, we can show someone how they could have the proper amount of whole life insurance. You can have too much in retirement, and you could also have not enough from a retirement income planning perspective. Can someone please take themselves off mute and tell me what was that ratio that was quote unquote the optimal mix? Does anyone remember?
1-to-1.
Bingo, 1-to-1. And what does 1-to-1 mean? What was it measuring?
The amount of assets compared to the death benefit.
Bingo, the amount of retirement assets, their account values to death benefit. Okay, so I'm meeting with Jay and Wendy. We're going through things. I always start at, I'm going to show you how to be as efficient as possible with your resources. And then from there, we scale back. So I want to just show you here. here's ultimately what we were getting ready to do. Okay. Notice they're still saving the same amount of money. All right. They're just moving some from their left, all of it in their right pocket, and they're moving some of it to their left. So they're splitting some of their savings, and they're doing it by putting $13,000 a year into base whole life premium on Jay, $5,000 on Wendy. And look at these ratios, 45 and 32. So a pause point is that from a retirement income planning perspective, was this going to be the biggest impact I could show them? I'll just give you the answer. No, right? It was like they're nowhere near 1-to-1. And here's why this is important. Okay. Just because that 1-to-1 ratio is optimal doesn't mean that everyone can do it based upon their time or their health or their cash flow capacity, right? To acquire life insurance, you need to have good health and you need to have the money to do it for whole life insurance, right? So just because they can't get to 1-to-1, does it mean that we can't make an impact? No. And sometimes, and probably more often than not, it's not that they can't get to 1-to-1. It's that for whatever reason, they don't want to, right? They don't want to reposition the amount of dollars that it will take in order to do that. Okay. And you got to keep in mind from a psychology perspective, especially Jay and Wendy here, right? They were buy term invest the difference people. And they were now settling on putting $18,000 a year into whole life insurance to change their thought process and to then stroke a check for 18. I know it's not additional funds, but to stroke a check for 18 into a financial vehicle that for the longest time they have been conditioned is something they should completely stay away from. Is that a pretty large leap for them? I can tell you it certainly was. Okay. And so trust me, I tried to get them to do more. I tried to show them the impact of doing more. And this is what was comfortable for them. In fact, one of the biggest things, the match on Jay's 401k, he only had to put in, it was one of the craziest matches I'd ever seen. He only had to put in, it was more than dollar for dollar. He had to put in like $4,000 to get his $6,000 match. Like it was crazy. So obviously, as I was saying, hey, we're out of whack on 1-to-1. We need to acquire more insurance. So let's back that 18,000 going into your 401k down further, free up some dollars, and we'll acquire more, right? And he didn't want to do it. You know what his biggest objection to that, which, you know, this to me is, I feel like darn near impossible to overcome, because I feel like we shouldn't even attempt it. It was, hey, Brent, I have a very steady job. I've been in here in a while, but I still always play this what if game in my mind. And if I were to lose my job, I am not obligated to continue to put my money in my 401k. Whereas with the whole life premiums, at least for quite a period of time, I am going to be obligated. And so that high of an amount, just, I can't stomach it. Right? Like there's not a whole lot to come back to with that, because who are we to influence a client's comfort level, right? So anyways, I have some other thoughts on that, but I'll leave it at that. So the point here is they were not going to get 1-to-1. They didn't do what I recommended to them, but we are still going to make a large impact. Now, let me get right to, here's the other thing before I show you. When we get into future conversations around building these cases, there's oftentimes a lot of discussion around what SPIA rate should I use. And if you recall in session it was 2, I was going over 10% when I was drawing things out, 10%. And part of that was because historically speaking, it was accurate the way I phrased it. But number 2, it was just to make things simple, conveying an idea to the client. What you'll see here is I used a 7.5% SPIA on Jay and a 7% SPIA on Wendy. Part of which most people would tell you is conservative, in that they still have almost 15 years until they retire. And so my thought process that with what I feel comfortable with, what I could defend if I ever needed to, is I will take current rates and I'll add a point to it. Right. So regardless of if you agree with me on that piece or not, many people will go higher than that. Hey, more power to them. But
Brent, why is that you add a point to the current rate?
yeah, so part of what drives the biggest driver to SPIA rates are the interest rate environment that we're in. And we are in a very, very suppressed interest rate environment and have been for quite some time. So when I say that historically a 65-year-old male, that payout rate has been about 9.8%. You can see every single year what SPIA rates have been. And there are many years where they are over 12, in fact, over 14, but they're always in time periods to where interest rates are extremely, extremely high. So is it reasonable to assume that when they retire 15 years from now, interest rates may be larger than where they are today? No guarantee of it, but is it a reasonable assumption? I believe so. I can get behind that. So therefore, I'll take current rates and add a point to it. Current rates around for a 65-year-old male around 6.7. So it's a little bit less than that, 6.75 in that range. But yeah, so Eric, that's my thought.
Appreciate it.
Yes, sir. Okay, so let's get right to the summary. And I'm going to show this to you on the screen. So okay, so here's where we're at. So this is what they're getting ready to do, right? So I've gone through multiple iterations with them. I can show them larger impacts, but for whatever reason, they're not wanting to do it. And as we look at this, if they would just keep doing what they're doing, okay, they would be on track for $130,000 a year of income. Okay, now, is that good? Well, that's relative, right? Compared to what? Okay, compared to half of that, yeah, that's fantastic. But compared to being able to do more without taking any more risk and without saving any more money, perhaps not so much. All right. So what I was able to show them that they could either add whole life insurance to their personal economy and either create their own pension when they retire to a tune of about $163,000 a year, over 100 of which is fully guaranteed to them by way of the pension amount. Okay. Or disrupt that assumption of the curves, allowing them to take larger withdrawals out of their accounts because they have that cash value there as a buffer. Now, other quick quiz moment. Anyone recall, what did I say that target years of buffer, the target range that we're shooting for when designing this, was how many years of income built up into the cash value?
4.
You split the difference. Yeah, so it's right anywhere between 3 and 5. 3 and 5. So notice here, I'm just under 3. Now, this is also, as you'll see here later when you look at the actual policies on this progression, this is a static number. All of us on this call, we recognize that cash value is contractually guaranteed to increase. So if on the day they retire, it's at 3, it's going to continue to grow from there. All right. So yes, this is just under 3, but those conversations were had. They felt good about it. Everything was good. So as we look at this, let's look at what type of an impact they were getting ready to sign up for. Let's just call it 128,000 versus 163,000. Right? So almost a 30% increase. All right. Now, again, remember, could it have been more? Yes, it could have. But in that moment, they did not want to do what was required in order for that number to be larger. I can tell you guys, they were jumping up and down. In fact, the number on the screen that they were most excited about wasn't the 163. It was this number right here. It was the amount guaranteed. Jay said, you know, man, my gosh, that's darn near the amount that we would have without this. And I like this idea of having a set amount of fixed income coming in. That's really cool. That's great. And so he was very, very Wendy both. They were very, very excited about that. Okay. Now on the second training that we did, when we looked at the screen similar to this, I had you all take out your cell phone, do that calculation to see the real impact of that. Go back and watch that recording if you need to, just for the sake of time. But this, I would argue that there was still a lot of impact made for them here. Okay. Now here's what happened. One of the coolest things, first time it had ever happened to me. And I made sure that it never happened again in the future. So by doing a better job on the front end myself. So for whatever reason, I had said to them, does this represent everything in your financial picture that we're simulating here? Is there anything that we're missing? Because one of the things they noticed, they were like, you know what? I see that this is much better, but we're also making 275 now. So we are still going to be making, you know, a drop, right? But I said, well, are we taking everything into consideration? Have we left anything off? And candidly, guys, I expected the answer of that to be no, this is it. And here's what happened. They go, no, that's pretty much it, right? Right, Wendy? She said, yeah. She goes, well, you know, yeah, aside from Ben's college fund, you know, yeah, we're good. I said, oh, okay. You know, what's going on there? What are your plans? So they have one child. His name is Ben. He's 15 years old. Okay. And about a little over a year prior to me meeting with them, Jay's mother had passed away. Okay. And part of her wishes were she left money specifically for Ben to be able to go to school. Okay. And she wanted to be able to have the funds for that. Right. So they tell me, so I'm like, oh, that's great. You know, so how much is that? And they said it's about 235,000. So, oh, wow. Yeah, that's great. You know, he can basically go to any school that he wants and all that. And they said, yeah, so we right now just have it sitting in cash. It's in a savings account. When he goes to school in just over 3 years from now, we'll just be paying for tuition and everything out of that. So my mind starts going wild, right? And I'm thinking, okay, hold on a second. Like this money, back to this idea, I want you to visualize the stair steps. Visualize this idea that if we have $235,000 that is going to be earmarked to pay for college, that's great. And they're carrying out the wishes. And it's fantastic that grandma, you know, designed for this to happen. That's all well and good. But the fact remains that money, once it's exchanged for, in this case, college, can no longer work for them or for Ben. Do we all agree with that? So I said, hey, wait a minute. So I'm totally on board with you guys wanting to pay for Ben's college. I think that's fantastic. So great of your mom to do that. But I need to get more details. But if I could show you a way how you could put Ben through school and pay for it all, but also make a large impact to everything that you see on the screen right now from your retirement income perspective. If we could do both of those things, would you want to see that? And they said, well, of course. So guys, I kid you not, in this meeting, because I had already had like 4 leading up to this around case design, because they were very, 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 very analytical, very, very into this. In this meeting, I had all the documents ready for them to sign the e-check form, $18,000. Let's put this thing in force and let's go. Like it was there. And in my mind, and in a split-second decision, I said, you know what? No. Okay. Would this interest you? And they said, well, sure. I said, okay, can't do it right now, but let's set up another meeting and let me pick up from there. So I stopped this, maybe perhaps a little risky. I had all the momentum going right there to then go through this further. So here's what happened. I'm going back through. They're like, yeah, we're ready to do this. We're all in. So, okay. So I go back through, and all of us on this call here recognize that, all right, if I'm going to use that money, that $235,000 to funnel into these whole life policies that I've already gotten commitment that 18,000 of base premium is my max number. Like I can't go over that because they don't want to, they're not comfortable with it. So I know my base, limitations. So the idea would be how quickly can I get that 235,000 of cash into these two contracts, knowing that in about 3 years, just over 3 years, they're gonna have to start paying for Ben's education, which means taking loans from the policy. We all get that now, right? Which means they're gonna have to be taking loans. Then what's the next piece of information that I would have to figure out? I would have to address if this was gonna work for them. And that is an if, by the way. What would need to be able to happen in that narrative? What other piece of financial information would have to be present? Any ideas?
Somebody to insure up to the amount of money that you, death benefit that you would need.
Okay, so I already got that because they were getting ready to do these two policies. So good call out, David, but we can check the box there. Anything else? If I'm taking a loan from this policy, back to the idea of, hey, there are rules attached to this. What do I need to make sure they can do?
You gotta make sure they can pay it back.
Bingo. Now, are they required to pay it back? No,
No.
right? They control the terms. That was part of the beauty of it that we went over last time. Okay, but if they don't pay it back, then it's going to be working compounded against them, and they're not going to have the increased death benefits and the increased cash value because they're going to have loans outstanding, right? So it comes down to, all right, I've got two options. I either could determine, does it make sense to reduce the savings component of, let's say, some of their outside accounts, or in this case, the 401k? Would it make sense to back those down, even though he didn't want to, back those down to then pay back policy loan? And would the increased death benefit and cash value at the time of retirement make a larger impact than what the accumulation of those dollars would do for him? That would be my first thing. But then here was my second thing. I go back through my fact finder, and this was again the mistake that I made. And they had just done a home renovation. And they shared with me that their home was going to be paid for. Remember, they're Dave Ramsey people, right? Their home was going to be paid for in just about 4 years. Okay. And their mortgage payment on their home was $2,500 a month. So in the moment, I didn't ask them much about that early on. I was just like, hey, okay, that's awesome. That's cool. You know, so on and so forth. But as I start thinking about this, I said, aha, okay, here's what I need to determine. I need to determine, are they going to continue saving that money when their mortgage is paid off, or are they now going to consume it? Regardless of their answer, I have $2,500 a month of additional cash flow, do I not? I do. Okay, so check this out for a second. Let me go to the drawing board here. Or let me first do this. So we first have to determine, are you going to continue saving that money? And what do you think their answer to me was?
Yes.
Yes, sir. It was. And I challenged them on it because where I was going to go was, all right, I'm perhaps going to be committing these dollars. So I need to know. And what they've said is, Brent, we have not been living off that money. So we want to continue to save it from that point until we retire. All right, someone in your mind, rhetorical answer, how many years do I have until they retire? 14. Their home's going to be paid off in how long? 4 years. So that means when their home is paid for, I have 10 more years for them to be saving that $2,500 a month or 30 grand a year and growing another pot of money that was not represented on that WBC initial output. We all agree with that? Okay, so let's look at this for a second. So how much would that be? That's my starting point. My starting point is if you tell me that you want to continue to save that money, I need to determine what's it going to grow to, and then what's the income off of it going to be. Okay, so monthly, they currently, none of it, $2,500 a month. Whoops, 25,000, that'd be cool. $2,500 a month, keep it consistent, and I'll use the net 6% growth rate. Remember, I have 10 years at this point between when the house is paid for and when they retire, so 120 months, and that would be $411,000. So what this means is on that WBC output, the salmon, blue, and green, they're going to have an additional, assuming these numbers, they're going to have an additional $400,000 that can then generate income for them that was not represented there. Okay, so here's what you're going to see. Let's pull that back up. All right, so this is the exact same scenario. Here's the only thing that's different with what they're doing here. I haven't changed anything, but look at this column. And again, go back and watch this recording. This column right here, one-time lump sum additional at retirement. See that $415,000 number? Okay, that 415 is being added to what this 150 plus 3,000 was growing to. So it's saying, hey, at retirement, boom, we're adding an additional $415,000 to this that they then can generate income off of. Now notice down here, once we're involving the life insurance, is that 415 represented anywhere here on this one-time lump sum? It is not. Okay. Why is it not? Someone come off mute real quick. What am I going to do with that money instead of grow it? I'm going to use it to pay off what? Come on.
A loan.
Policy loans, right? Thank you, Eric. Okay, so if I can make this work out, that would be nice. All right, so here's what we can do. 235,000. Remember, Jay's policy is 13,000 of base premium. Okay, Wendy's policy, is 5,000 of base. All right, and I've got this pot of 235,000. All right, so my starting point would be, all right, I'm trying to get this in as quickly as possible, but without mecking the contract, because that would change all of this. That wouldn't work, right? So how quickly can I get that in? And part of this is trial and error, and I had a pretty good feel of where I was at, but I divided this 235,000 over 5 years. So I basically said, hey, if we funnel this money into these two contracts in a 5-year clip, what would that come out to be? And that was 47,000. So equals 47,000. All right, 235,000 divided by 5 is 47,000. So if I could use that 47,000 as PUA contributions to these two policies and not mech the contract, what might that look like? Okay, but that's still not all the details yet that we have to check. The final one is, okay, what does the actual loan look like? And in a perfect world, when would the loan, the policy loans, when would they be paid off? By what date? By the time of retirement, right? If I could have those loans, the policy loans paid for at the time of retirement, then I already know that there will be a huge impact for them, because all of those PUAs, that additional 235,000, not only, think back to the graph of what is it doing for me? It's doing two things. It's cash value in the short term, yes, but it's also death benefit, right? And it's compounding for me. So I know that they will have more cash at age 65 when he retires, and death benefit, which is going to inch me closer to my 1-to-1 ratio, right? Thus driving their income. And if I had the loan paid for, what would that look like? So here's how we're going to do this. Loan balance, 235,000. All right. If they funnel the 235 over 5 years into the contract, 3 years from now, when Ben starts going to school, they take money out for year 1, and then year 2, 3, 4, so on and so forth. And then when their home is paid for shortly thereafter, if we can use that $2,500 a month to pay off the loan, then where would we be? So just watch this, and you're going to start laughing probably, because you're thinking like, oh my gosh, this is too good to be true. 235,000, 5% interest. The insurance company is charging me 5% interest, right? Which we all agreed was, hey, this is a heck of a deal, because we're continuing to have the use and the growth of our money. All right, but a 5% interest rate. And if I paid it off over 10 years, that would be the exact same time frame that we have the freed up mortgage payment. Agreed? Let's check this out. 120 months. What's my monthly payment? Someone just come off mute and hoop and holler. What's my monthly payment?
2,500.
2,500, 2,492, which means, scroll to the bottom here, that it's possible that if Jay and Wendy take their $2,500 a month mortgage payment, okay, that freed up mortgage payment, and they pay back this loan that Ben's going to take for school, that on the day they retire, what happens? Ben's been through school, which is what grandma wanted, right? There's no debt for it, none of that sort of stuff. Jay and Wendy's house is paid for. Their policy loan is completely satisfied, so they owe no money on anything. But yet now I have all this extra $235,000 that went in on the first 5 years, both in cash at retirement and death benefit. That's a beautiful thing, right? In fact, let's look at this further. Here's what we ended up doing. Of that 47,000, you're going to see that 37,000 goes into Jay's policy in PUA for 5 years. 10,000 goes into Wendy's policy for 5 years. In year 6 and beyond, it just drops back down to the base premium. And here are the policies. Let me pull it up. Whoops. Here's what you can see. This is Jay's policy. Let's look at them together. So it's 65,000 over 5 years. That's the 18,000 plus the 47,000. At the end of 5 years, the 235 is no longer in their savings account. It's in their policies, right? Then we drop to the base premium thereafter. Here is combined cash value. There's plenty of liquidity here. They're not even going to start loaning on this thing for about 3 years when Ben goes to school. All right. And they're not going to do it all at once. They're going to take it out year by year. The combined death benefit, here's individually. Here's Jay's policy. Here's Wendy's policy. Now let's go back to the impact. Watch this. All right. So remember, everything was the same. Up here, they got an additional $415,000. That would be the money that was the freed up from the mortgage payment and grows for 10 years. and then is used for retirement income. Whereas here, there is no money because the money went into the cash value. That's why you can see here in year one, it's representing year one cash value, 36,000 for Jay, 9,700 for Wendy. Remember, his was 37, hers was 10. You got the sales load on top of it, a little bit of expenses. We went through that, and then it grows from there. Someone tell me my ratios. Are we better than what we were?
Yes.
Darn near, right? Are they still at are they still at 1-to-1? Nope. But if you recall, they were in like the 40 and 30 range. So we definitely made impact, right? Okay, now let's forget this and let's go. Everything else stays the exact same. Let's go to the comparison. Everything else stays the exact same. In fact, I'll pull it up here for you. This is where we are at, right? This is where they were getting ready to sign the check. And they were staring down the gun barrel of 130,000 if they go at this themselves, or 163,000, which they were excited about. Okay. Then we recognize that, you know what, that 120, even the 128 right here, that is still, we shortchanged them because of the mortgage that was going to be paid off. There was an additional 400 and some grand that was going to be there to generate income. So we already know that this is lower, but watch what happens here. This is what they were good with. Here's the scenario now with all of the PUAs going into the contract. 163,000, which they were excited about, to now almost 210,000 of total income. Look at this. 180,000 of which is fully guaranteed through way of the pension payment, through way of the SPIA. Remember, it was the 100 here that Jay was most excited about, right? Having that guaranteed cash flow, consistent paycheck coming through, 100. Now it's 180. Now it's 180. Remember the interest rate or the impact that we had for them under this example, which again, they were getting ready to move forward with, a 27% increase, 27% increase in income. All right, from that to where now, when we look at things in their entirety, what type of an impact do we make? We go from 143 to 209. Boom. A 46% increase in day one retirement income because of this. Let's take this progression out just a little bit further. Okay, so where they were initially was 100, what did I say? 128. Okay, so I need this one and I need this one. Okay. Gosh darn it. Okay, so they were going to be at 128. All right, and then we find out that we did not take into account the mortgage being paid off. So without me in their life, they would have gone from 128 to 143. Okay, so that in and of itself was an 11% increase that we just didn't represent there. All right, but then ultimately we go from 143 up to 209. So could I say it this way, that from the day that we started talking, they went from 128,000 of what they were anticipating, what they were getting ready to move forward with, from 128 to 200, 209. Yep, 63%. So look, my point with this, hopefully what you're seeing is this just comes down to the flow of money and to the most efficient use for whatever the objective might be. You know, clients will say all the time, hey, I want to pay for my kids' education. And whatever their reason might be, hey, that's great. Regardless of what my thoughts might be, I think it's noble for them to want to do it. And then they'll say, and I plan to do it through a 529. Well, not all the time is that the best method for carrying out what their desire was. Their desire was to pay for school. No problem there. But if there's a more efficient process to accomplish that same thing, when would you want to hear about it? I know the answer for me would be yesterday, right? So again, just to recap this, I think this is a perfect case to look at. That was, look, this started with someone with individuals, Jay and Wendy, that wanted nothing to do with whole life insurance. They had been great savers. They had accumulated wealth. They had no debt. They had accelerated the payoff of their home, right? That's what they had been told to do. Then rewiring their thought process to be around beginning with the end in mind, to be income. They saw the value. All right. They were making the psychological shift into doing something they never had done before because they saw value with it. They couldn't go all the way because it was too much of a leap, but they put themselves in a better situation to then recognizing the mechanics of the tool itself and tying that to grandma's desire to have Ben go to education and not have Jay and Wendy or Ben come out with any debt, and funnel that money into those vehicles, still allow Ben to go, have identified freed up cash flow to satisfy all policy loans in the exact same time frame, thus driving their income and their options to create income in retirement significantly higher than if they did not think about the origination point differently. And that is ultimately the biggest thing here. So whether it is an investment opportunity like we looked at last week, or it is a major life expense, when you can then have the control and the discipline and the accounting system to put more money onto your side of the ledger, your clients and you will come out ahead. So 4 minutes. I know there was a lot there. Bring yourself off mute. I'd love to hear thoughts or observations or something around this. I'm going to stop sharing just for a minute, just so I can be full screen.
At that comeback meeting, Brent, where you brought about this scenario of the mechanics of using the payback strategy through IBC, what was their reaction? And how hard was it for them to grasp that idea?
It was not hard at all. It happened in one meeting, and they signed the check for $65,000 after that meeting. Now, part of that was because I mentioned that I had 4 meetings with them just around the case design of WBC leading up to that, not to mention the 2 or so meetings before getting them into underwriting. And I mean, we had been talking a lot. This was a 4-month process, if I remember correctly. So the rapport was there, all of that type of stuff, that I was able to perhaps even communicate with them a little bit differently in that 7th meeting than if that would have been my lead with them on, hey, you got this money over here.
Sure.
Let me show you how to best pay for college. It would have gone down differently. But in this instance, they got it. And it just so happens, like, the way that the math and the time frame and all that, it was so aligned that made it easier too.
Yeah.
If they would have had to carry, like, all of us think about this, if they would have had to carry those policy loans into a few years into retirement, could we all recognize, even off the top of our head, that perhaps still could have been the best thing for them to do? absolutely. Look at the increase of income that we were creating for them. That if we have to pay 2-3 more years on loans, I mean, my gosh, they're still ahead. So but I believe, Jason, the fact that all of that was so like to a T, it probably did accelerate the process.
Yeah, Brent, how impactful it is. Let's keep in mind that these two individuals had exposure to Dave Ramsey, and we all know what Dave Ramsey's approach, what a detractor he is. It brings up the opinion, or everybody's entitled to their opinion, but nobody's entitled to their own facts. And what this demonstrates to me is that if you have a structured architectural design that people find that's easy to grasp, you're a winner.
If you can show people how to get what they want, and that's the forefront of every single conversation that we have with our clients, to your point, Jeff, you're going to win.
Brent, I got a quick one for you on the covered asset strategy with younger clients. One of the things that you find out is, you know, these 401ks, they're projected out to be 3 million, 4 million. They make, you know, 100 grand a year. Trying to get them to grasp having a $3 million death benefit, and then getting them through underwriting and to do that. What are your thoughts on that? I get to a point where I can't get the full covered asset strategy covered, I guess I should say. And that's where I would use more of the volatility buffer approach with them. But what are your thoughts on that?
Yeah, perfect. So the way I'm going to answer that is, yes, this does happen. I get involved in a lot of cases with underwriting to where they'll say, hey, Brent, the agent's telling me this is a WBC case, and I can't get there. Am I seeing this wrong, or what have you? And sometimes it just is what it is. And there were some growth assumptions about those accounts that perhaps were a little ambitious, and underwriting can't get there. Other times I'll say, you know, look, this is one that I would fight for. So at the end of the day, what we have to keep in mind is this is life insurance, and an underwriter's job is to determine the economic value of someone's life purely from a financial perspective. And the insurance company is not going to put more protection in force than what that person is worth. So if they are outside, Eric, in your younger example, oftentimes this is an income multiple driver. If they are outside of that, then yes, I think focusing on the other aspect of it, or still the overall increase that can be made, is the way to go. But the second thing I'm going to say is I do find often that advisors latch on to the covered asset strategy or the volatility buffer, and not all the time, like in conjunction with one another. And I'll have people ask me, hey, Brent, can you come on and do some sort of a training with us of why whole life insurance is the best volatility buffer vehicle? And it's like, sure, but recognize that part of why it's the best for that is because you have the ability to have this leveraged death benefit. So why I bring that up, Eric, is trying to stay neutral on this throughout the conversation with the client. And I'll use language of, hey, you know what, when you get there, you're probably going to do a combination of the two. But the fact is, without this in place, you can't make either decision. So I love what you said. Sometimes with underwriting, if you can't get there, maybe spend a little bit more time on the other. But outside of that, they're both extremely powerful, and they're not making that decision today. Good question.
In this past case, it was the valuing of the guaranteed income as well that made them go with the covered asset option. And for that person who wants to continue to have flexibility with some of their other accounts, they might choose volatility.
Totally. And you know, like, so I try very hard to, although Jay was most excited about that, we still have to keep in mind that it's not like clients are deciding today that they're implementing that, right? It was 14 years into the future before that decision is made. But, you know, to your point, Jason, that still may be the driver of the decision making, but who knows what things are going to be like at that point. Maybe there's a laddered strategy. Maybe there, lots of different things.
Yeah, good point. Anything else? Final word, final question for Brent?
Yeah, I'll ask real quick. Brent, you had mentioned earlier that on the upfront, the importance of being thorough when doing the needs analysis. And, in that example, you'd forgotten about the potential college funds and how that played into the scenario. From a more practical standpoint, for me, because I'm actually doing a needs analysis in an hour for another client, any other got you kind of like things to look out for, that there may be potentially money there, or just like a college fund, that just to keep in mind so I don't miss anything?
I will oftentimes ask about the family situation.
Mhm.
It's referral opportunities. Perhaps mom and dad are a little bit older and there's a need for asset-based long-term care or what have you. But I will start to open that up also to uncover, is there a family business? Is there an expected inheritance that's going to be coming down the way? And so it's not for anything that we're going to do with it today, but just that nice to know information. And outside of that, Saul, I would say one of the biggest things that I changed after that was, rather than asking the question of, are we representing everything to simulate in this moment at the very end, I'll do it at the end of gathering all of my data, right? So in the event I did miss something, I get it there. But I will say, I think we all probably have experienced that not all the time are right from the jump the clients wanting to disclose everything about their financial picture. And oftentimes we have to earn that right. So maybe having a couple different checkpoints as the trust and credibility is continuing to expand is probably a good best practice.
Got it. Thank you, Brent.
Yes, sir.
Well, thank you again, Brent. We really appreciate it. We'll continue to celebrate what you've done here these past 5 weeks and hook you into other ways to keep this alive for us. Like you said, this is the foundation for kind of taking the reins on our own and making this happen in our practices. And just to remind everybody, we'll, as Wella, try to help you begin to do that next week at our firm-wide meeting. So thank you. Have a good rest of the week, and we'll see y'all soon.
Thanks, everyone. Good to be with you.
Thank you.
You're welcome.